Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Khleif, and I'm thrilled you're here. And I know you're going to get tremendous value from the dynamic gentleman we're interviewing today. His name's Keith Wasserman. Now, Keith's been involved in over $1 billion in asset acquisitions, presently owns thousands of units, has owned as many as 75, has been involved in 7,500 units that he's purchased between apartments and mobile home park spaces, and just has a tremendous amount of value to add. Keith, welcome to the show, buddy.
Yeah, thanks for having me, Rod. I'm excited to be here.
Absolutely. So, let's start the way most of these things start out by having you tell my listeners how you got started, why real estate, when real estate, and let's just talk about the early days.
Yeah, definitely. So my story goes, I've always been very entrepreneurial. In my family back, when I was growing up, we didn't really talk about sports and entertainment. I always talked to my dad about business, and he introduced me at a young age to, some of the values of learning to buy, right, and buying wholesale and selling retail. And when I was 10 years old, my dad would go with me to Costco. We would buy boxes of candy bars and then, buy wholesale and then sell them at the park, one by one retail. So just learning how to deal with customers. And, when I was 13 years old, I started investing my bar mitzvah money in the stock market. When I was 15 years old, I started buying these, they're called irregulars, these leather jackets that had small imperfections. I bought them for $10 a piece, and I sold for $100 a piece to all the students at my high school, the teachers, the janitors, the parents. I had a whole car of leather jackets I was selling, and I just learned the value of buying right, the right price, and just being able to mark it up and sell it. And not being afraid to negotiate was what I really learned at an early age. And that really helped me later on where I started my next business. I started something called Keith's Bargain Center. We were one of the top 500 eBay stores in the world. We sold 200,000 items. This was during the years 2003 to 2007. I was at USC, University of Southern California. I had a 5,000 square foot warehouse down the street, and I really learned how to deal with customers, deal with my employees, just running a business, and all those things greatly affected my next business, which is my current business, Gelt. And we started in 2008, and we've really grown from a small 4-unit building, and I'll talk more about that later, and to the 7,500 unit budding empire that we're building. So yeah.
Wow, that's quite a story. Now, so you started in 2008. You lucky SOB. That way you couldn't have picked a better time to get started. And I gotta tell you, it's kind of a reoccurring theme on this podcast. When I get somebody that owns thousands of units, they started in 8, 9, 10, 11. When I was licking my wounds hiding underneath a rock. So good for you. So.
It's really, I call myself a professional opportunist, and this was December of '08 actually. So the financial crisis was in full gear, and my cousin, who's my now business partner, came to me with the opportunity to buy a single fourplex in Bakersfield, California, which is in the Central Valley of California. It's based on oil and agriculture. And it was really the only price point we could afford. It was $150,000 for a fourplex that previously sold for $500,000. Our mortgage payment when we bought it was only $600. Each unit rented for $695. So it was just a no-brainer. I mean, if we had half the building vacant, we were still cash flowing. So I just saw the downside as being very little. And also people were saying, real estate, it's a scary environment. Why are you going to Bakersfield? It's sort of was decimated with the housing bust. And those just drove me more to really investigate and be on the ground and learn the market and realize that, people are still going to need a place to live. This is affordable housing. It's not going anywhere. The replacement cost is so much higher. And it helped me take the plunge. So we bought it. We scraped together very few bucks. We got an FHA loan. So it was only
so you moved in. Good.
Yeah, Damien is a consultant, so he put the utilities in his name. He stayed in one of the units, and essentially we were able to get it with an FHA loan. We got a $10,000 cash advance on our credit card. We were able to do that at that time, and we borrowed $5,000 from a friend for the rehab, and that's how we got that one done. So it was whatever you need to do to be resourceful. Yeah.
Guys, those of you listening that haven't bought that first property, you've heard me say it before, start with a Plex. Here's a great example. Now, it's obviously tougher to find. You're not going to find that deal today, but there are still deals out there. There's still deals where you can live for free. And so that's fantastic. So how did you progress then? You started with a fourplex. Did you stay in that size range for a while, or did you jump up pretty quick?
Yeah, so all throughout '09, we were one of the largest buyers in Bakersfield of these fourplexes. We bought 15 of these fourplexes. They were all abandoned, REO, bank-owned, on the rougher parts of town, because those were just the affordable price points for us. The second fourplex, I put my savings at the time. It was like $35,000 into the down payment. My cousin Damien got on the loan. It was tough to qualify for the loans because it was just during the recession. And
oh, sure. No, it was very difficult to get financing back then.
I was self-employed, and it was very tough to get, but he had W-9 income. He was able to qualify for the loan. So he got on the loan, and we bought the second one. The third one, we raised money from a family friend. Fourth one, we did from another family friend. And we bought 15 of these fourplexes with maybe 3 or 4 investors. And then we started December of 2009, a full year later, we made the plunge and bought a 78 unit also in Bakersfield, California. The purchase price was $3.9 million. We raised $1.3 million of equity from around 8 investors. The 8 investors were comprised of myself, my cousin, my dad, and then family members and some of my dad's clients. He's an attorney, so some of his early clients that have been with him a long time. And we cobbled that money together. Along the way, we gained mentors and partners like my dad and another gentleman, we call him the gray hairs, that will help us qualify for these loans. We couldn't qualify for those loans, so we had them we brought them in as partners, and that's what helped us get to the next level and start buying apartment communities where we could add value through adding amenities and repositioning and just making it a better community to live in. That was the first bigger apartment community, but it was a full year later.
So back to that 78 unit, did you get agency debt or did you get bank financing on that?
Agency debt. It was a struggle because we weren't managing ourselves. We only had those fourplexes. So this is our first bigger one. It was a struggle, but we hired a local property management company that managed a lot of units there. And that helped us get the loan done. And it was, 90% of our financing to this day is done with agency Fannie Freddie. It's just the most aggressive, get the highest leverage, best interest-only terms. And
sure.
So, but without my dad and our other gray hair partner, we couldn't have built this business. And it's been having that person to help bring you to the next level. We've had great mentors, partners.
Yeah, mentors are critical, and I will tell you, that's the reason I asked the question was how you got that agency debt, because you didn't have the experience component. So you brought in a property management company for that
Correct.
Component. Was it Freddie Mac then?
Yeah, I think it was either Fannie or Freddie loan, one of the two.
It was probably Freddie Mac. They're more receptive to bringing in a property management company for the experience component, but then you used your dad for the equity. I'm sorry, for the liquidity and the net worth requirements.
Yeah, because we need 10% of the loan needs to be liquid, so I didn't have that at the time, and
sure.
So that was what we needed to do to get something done,
Yeah, I just want my listeners to hear that, because there's a lot of guys that are just starting out that they're like, how am I going to take down a big property? So that's what you did. You cobbled together those pieces. It's a team sport, guys. So, you brought the experience in from a property management company, and then you brought in the liquidity, the net worth with your dad, which you could, those of you out there, know a doctor or know somebody that's a high net worth individual, you bring them in, and that's how you do this. Awesome. 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 So, wow. And then you just took off. And
took off. The next year we bought in Bakersfield a 128 unit, and then we bought a 25 unit REO there. And then towards the end of the year, we bought in Phoenix, because we studied Phoenix and we realized Phoenix is not going anywhere. It was the 5th largest city in the United States. It was decimated by the recession. It had a huge boom and then a subsequent bust. It was just reeling. They had the immigration bill, over 100,000 people left, and it was just blood in the streets. And we were over there in 2009, 10, and we were buying deals, and we were able to retrade at that time. And now we don't even dare retrade because there's backup offer. It's a different time now, but we were able to get great buys. At the time, did we know they were going to be that great? No, we just knew in our gut that, we were buying so below replacement cost, and it was a time in the market that everyone was fearful, and
it's fantastic. It's funny. There was just a thread on Facebook about, about an upcoming contraction, because this stuff all goes in cycles, and we're definitely going to have a contraction. And how it's one of the participants in the thread posted just how scary it is to actually invest when there's blood running in the streets. But if you're able to do that, if you're able to realize that it always comes back. I mean, cities like Detroit are coming back. They always come back. Phoenix, no brainer.
Yeah.
Florida, no brainer. I mean, 80 million baby boomers getting old and getting cold. Phoenix and Florida, they're fine, but they were decimated by this thing. I was decimated by this thing, and so, it's no, you were in the right place at the right time, but you took action too.
Definitely took action, and we plunged, we dove in, and just we sort of have changed over the years. We started in Phoenix, which is historically a very boom and bust. We've since exited. We bought 2,000 units over 2010, 11, 12 in Phoenix. We've made our investors a ton of money there. And then we moved to more markets that we feel are a little slow and more stable growth, like Salt Lake City. We bought 1,000 units there. Denver has totally transformed. In the last few years, we've been buying there. We've seen tremendous rent growth. It is slowing down, though.
Sure. No, it is slowing down right now for sure. I mean, I know that market, like I mentioned to you before we started recording. That's my hometown, so I know that market like the back of my hand. And when you told me you had property there, I'm like, oh, that's fantastic, because it's just it's nuts there. But fantastic. So tell us about as you've grown this thing. You don't self-manage then. You use third-party management everywhere?
Correct. It's all third-party management. And just because we're in 10 different states now, and it just logistically would be pretty crazy. If we were all in one market, it'd make more sense.
Sure.
So it's pretty much a commodity. We pay very little for the property management. I mean, we're one of the biggest clients of a lot of our management companies. We work with like 4 or 5 just of the best regional management companies in those areas. And I think they would do a better job in terms of like buying in bulk, economies of scale, training the personnel. We're not really in the people business. We have 17 people here in the office, and otherwise I'd have 150 plus if we had all the employees on the sites, and we would have to be constantly, there's always a lot of turnover.
It's a training curve. I mean, get it. I totally get it. No, and in your situation, it makes sense. I mean, I'm a big advocate for self-management if it makes sense, but I don't think in your case it does. Now, let me ask you this. You talked about 17 people in your office. So that's what you've grown to now. Give us an idea of the components of those 17 people. What are the pieces? You have researchers, analysts. What do you have in all those?
So it's pretty cool how we've grown. We've only hired out one person. That's the CFO. Everyone else, like every week I have people coming to meet with me that want to join our team and want to learn what we're doing. And it's really cool because I get to cherry pick who I really like, and we sort of create the position for them. So even if we don't have a position at that time, and that's how we've done it from the beginning. It was originally just me and my cousin, and then we brought in another younger gentleman. And at the beginning, they were really hungry. They got equity in the company. They were making very little, like under $1,000 a month. And then as the years went by, we were at $2,000 a month, $3,000 a month, and just were able to pay more as we got bigger. But they took the risk of joining us, a younger company that were growing quickly, and just really learned the business by doing. I mean, just like we did. And we started with a gentleman that, at the beginning we did everything, right? So in the beginning, I was on the weekly conference calls with the property management companies. I was scouring Craigslist to make sure they were posting correctly and reviewing all the weekly reports. Now, as we've evolved, I'm sort of overseeing our staff that are overseeing these processes. So we have an asset management department. We have a head of director of asset management and a few asset managers under him. We have a whole accounting department with 5 people. So we're set up as a syndication business. We have over 500 investors. So it's very intensive dealing with when the quarters come. We do quarterly distributions, and we're trying to streamline that. And we've gone on ACH instead of checks, et cetera. But we have a large accounting department. Then we have our acquisitions department. I now have a COO, a director of acquisitions, and a financial analyst under them. And we have, since it's a syndication business, I myself am focused on pretty much the money raising and the marketing of the business. And we have an in-house attorney who also doubles as he raises money in China. He's a Chinese individual, Chinese American, goes back and forth to China. And then on the legal front, my dad's our partner. Even though he's his own law firm, he is a partner in the business, and he has 2 people technically on his payroll, but it's the paralegal and the transaction coordinator. So that's what makes this office run pretty much. So everyone's sort of compartmentalized, but I encourage, we do like quarterly, every quarter we meet as a big team and talk about what we're seeing and what we're doing, and trying to bounce ideas off each other. And really, it's like a family-run business. And I told everyone this is like my second family. I have my family at home, and then my work family, and it's just great to see everyone grow. And
oh, sure, no, that's the way to have it. When you enjoy going to work, and the people you work with, and you respect them, and you trust them, and you rely on them, and you empower them. I mean, it doesn't get any better than that. Love it. So let me ask you some more general questions, if you don't mind. Let's say what you know now, and I love to ask this question, especially people as successful as yourself. What would you tell your 20-year-old self about investing in real estate if you were to go back in time and do it all over again?
So that's a good question, Rod. I started this business when I was 24. If I was 20, I would have said, get started. There's never a wrong time to get into the real estate business, even if you're buying at the top of a current cycle. So
like now.
Right, like now, and it's scary. Yeah, I mean, it's not the ideal time, but you're going to be even pickier. Eventually, you're going to find that right deal. And as long as you have, so to mitigate our risks, we do everything we buy is with long-term fixed rate financing. So we do 10-year fixed rate or even 12-year fixed rate. So we're able to withstand any cycles. We don't want the loan coming due when the value's down and the rates are up maybe. And another thing we do is we raise a lot of extra capital up front for reserves for rainy day. So when rents and occupancy do drop, this is cyclical business as all businesses. We're going to be able to, if there's a shortage, we're not going to have to do a capital call to our investors. That's like the worst time to get money is when the market's bad. And maybe
that's the worst thing to do, period.
Yeah, people don't want to deal with that. And so we raise a little extra money up, or a good amount of extra money up front. So we have it in the bank account just sitting for a rainy day. And
can I ask you, I'm sorry to interrupt, but I don't want to move past without forgetting. How much do you typically, like today, how much extra would you put in the bank for a rainy day fund right now?
Depends on the property. Like the older buildings we're buying, they're pretty significant because we've seen it during the last recession. People lost buildings because A, they over leveraged, but B, they didn't have any reserves. And it's sort of a vicious cycle. The property started like deteriorating and then they weren't fixing things. And it just was a self-fulfilling downward spiral. So you got to have a lot of reserves. We reserve for, big ticket items for the next 10 years.
CapEx.
Asphalt, for CapEx, and then additionally for reserves. And each property, I mean, we don't have a set rule, but cumulatively, like all our properties have like around 30 million in the bank. So, that are just sitting there that we're not distributing to investors, and we have around probably 20, 30 properties. And so the larger the property, the more cash, and the older it is, usually the more cash we set aside. And sometimes we let that cash flow build up. So if the property throws off 8%, maybe we'll only distribute 7% and tuck away a little more cash flow while the times are good. So there's not a set hard rule, but it's a feel based on each property, maybe 1,000 or 2,000 per unit on average.
Okay. No, that's helpful right there. That's very helpful. Okay. Awesome. So, everybody, they look at this business and they see, especially when they see, incredible success, and they think it was a rosy path, that there was always it was always a bright light and it was always perfect and everything was working well. Is there a dark time in this journey of yours you'd be willing to share with my listeners?
Yeah. So I've been lucky that since we started, it's been, in the beginning days, we had to give a lot of free rent away, and it was more involved managing. We had to really make sure, we were doing everything perfectly. And we still do to this day, really make sure we run the properties well. But I'm lucky I haven't seen a down cycle yet, but eventually it's going to happen. And the worst things that have happened are more just people-wise, like learning to pick your partners well and stuff. We've had a couple of there was 5 of us in the beginning. Now it's only 3, and it was probably for the better. So I'd say, really spending time knowing someone before you go into business with them. And I'd say, second, probably undercapitalizing. One of the deals in the beginning, we didn't raise enough money for, and we just, probably should have raised a little more money. We did well with it. We did great, but I think we would have done even better if we were able to raise more money and put more money into the project. And then just every day we've had floods and fires, and we're always like literally putting out fires. I mean, in the property, we're dealing with the property management companies, and there's always, we've had shootings on the properties. When you're dealing with the general public, there's always different things going on. And, how you deal with that, I think, is important. And I think, being transparent with the investors, showing them the good, the bad, the ugly. You don't want to have, they hate surprises. So we're always very upfront. Haven't had any, the worst performing investments, honestly, were the fourplexes in the beginning, just because they were in the roughest parts of town. And we learned to start buying in better areas and paying up a little bit just because the performance would be better. And those have appreciated in value a lot more, and the cash flow has been more stable and stuff. So some of the early fourplexes, we didn't make as much money and stuff, but thank God we haven't had any really bad things.
Fair enough. No, that's awesome. I mean, you're blessed, and it sounds like you're preparing in advance of, so it really doesn't happen to you. Let me ask you this, based on what you've seen, why do you think people fail in this business? In your
I think they're too short-sighted. I think I didn't make any money in my partner for the first 3 years with these fourplexes, and every acquisition fee we rolled back into the deal. We're really trying to play the long game. Real estate is not a get-rich-quick. A lot of our peers have like institutional partners, and they're more focused on IRR, and they have to sell in a 3 to 5 year whole cycle. The wealthiest people I know in real estate are just the build slowly over time. And one day they wake up and, if they want to work, they could. If not, they don't have to. I love working. I'm a deal junkie. I love my family here at the office, and I'm always going to be, working. But I think just being patient, and it's not get rich quick. Set yourself up with good people that work with you, and, treat everyone fairly. In this business, people always ask what differentiates you from your competitors. I say our relationships. So the brokers really are like the golden geese, them and our investors. The broker, especially now, we just want to deal with 48 offers. I mean, it was insanity, but it's all about the relationships. We don't retrade deals anymore. In the beginning, we were able to a little bit, but now it's like there's always people behind you. So we do our heavy due diligence up front before going into contract, and making sure there's nothing that was majorly not identified. And
right.
we've even eaten a few $100,000. We could have gone in for a retrade, but we didn't, just because we want to keep a good relationship with the seller and the broker. So we've had multiple. We bought 5 deals from one group, 6 from another group, and then some of the same brokers we've dealt multiple times with, because they like dealing with us, and that's what wins us these deals, I think, is our relationships and how
Sure. No question. No question. In fact, I just interviewed a gentleman with 17,000 units. He used to have 35,000, and he said he's never retraded a deal. I mean, and when you have that kind of a reputation, I mean, who does a broker want to deal with? They know they're not going to be renegotiated. They know that, that's a done deal if it goes under contract. I mean, that's what they want. That's how they get paid.
100%.
Yeah. So let me ask you this: how do you manage your communication with your 500 investors? Tell me what that looks like. How do you keep them? How do you remain transparent? How do you keep those communication lines open and thriving?
Yeah. So my CFO incorporated a new software. It's sort of a startup. It's called IMS. They raised like $10 million, and they're doing really well. They investment management system, I believe it stands for. It's IMS, and our investors could log in and get their quarterly, updates. We do a quarterly newsletter with quarterly financials. It's all through. We have some people on paper check that's still like getting that paper check, but a lot of it's now moved to ACH. They could get their K1s there, so it's all moved online.
It's like a portal.
A portal. Whenever we have a new deal that goes out, we push it through on that. They could now see it on their cell phone, their mobile device. So. Nice. Implementing this IMS has been a lifesaver as we continue to grow. And, we started with 1 investor, and then 2, then 3. And it's just, we built this business 1 investor at a time and 1 property at a time through this.
So no regular conference calls, PowerPoint presentations, video conferencing, no actual verbal progress reports. It's all through the portal now.
I'd say one-on-one's been the best. We've had like an open house here in our new office where we invited all our investors, but my feeling is one-on-one relationships is always the best. So I try to constantly be in touch with our investors, pick up the phone, shoot them an email, have lunch with them. Just the personal relationship, I think, is the most important. And because they start telling their friends and family, and they're really investing in me and my team.
Yeah, that's why I asked. I just, it's kind of, the portal is a little bit impersonal. So I was just wondering what you incorporated with that, to maintain that visibility and that relationship. And that's why I asked the question. Okay.
Yeah, my phone's always open. I field calls from the investors all the time. I spend as much time as they need to feel comfortable, and I answer any questions that they have. We have investors that are very sophisticated to not sophisticated at all. And I'm available, and our team is available to explain everything to them pretty much.
Do you pursue like family offices and things of that nature for some of your investments?
Yeah, so we're trying to do more family offices. We're starting to work with more RIAs, registered investment advisors. But I'd say 90% of the money is still just individual investors. Minimum check size in the OM is stated at $100,000. But if someone wants to get started, as long as they're accredited, we can only deal with accredited investors. We'll let them in for $50,000. It's a deal by deal. It's not a fund. So
okay. So you do deal by deal. And by the way, those of you listening don't know what a family office is. It's when somebody, when you've got a high net worth, like in the hundreds of millions or $1 billion range, either company or individual, a lot of times they'll set up a family office to handle their investments, and they'll have attorneys on staff, accountants on staff, even security on staff, and it's kind of an interesting area. But a lot of the really big players pursue those family offices for investments and syndications and all sorts of other things. So, okay, so what would you say is one of the most important lessons you've learned from this multifamily investing business?
Oh man, one of the most important lessons. I'd say on the operations front, I've learned early on not to over-improve the buildings. A lot of our competitors, they think money will just cure all, and you can only improve to what the area demands. So, there's it's just always a fine balance of how much money you spend to get a certain ROI. Also, giving back has been big, what we're doing. We started a 501c3 called the Galp Foundation, and we're the first one that's really providing rental assistance in the form of grants and interest-free loans to residents that have historically been very responsible renters, but are at risk of eviction due to non-payment of rent. They have a job loss, they have a financial hardship. Almost 70% of Americans have less than $1,000 in savings. And this is our core demographic, just working class. It's not low class, we're not dealing with high end, it's just middle America kind of people. And we set up this foundation a few months ago. It's a 501c3 with the IRS. We've already helped 7 families and individuals that were at risk of eviction. Like 2 of them lost their jobs temporarily because of Hurricane Harvey. They had to keep making payment, but they weren't earning the income because their jobs were temporarily closed down. And we gave them that bridge to help them. And it wasn't even a full month rent. It was just a partial month rent. I think the longest person we've helped was 2 months, and they were back on their feet after 2 months. So it's really incredible.
That is freaking beautiful, man. I can't tell you how much I love that, and such a brilliant idea. I mean, you just hit me at my core. That's something I'm really believe in giving back, and the fact that you've incorporated that into your business, and you're right. There are people that just hit a bump, and they just need a hand for a short while, and talk about a tenant for life, at that point, when you're able to do that, that's fantastic. I mean, I have a foundation myself, and
cool.
It's dear to my heart. And so, yeah. And by the way, guys, I know, Keith, you're in LA, and I have my April event coming, April 6th, 7th, and 8th in LA. And Keith, you are invited. I'll publicly invite you if you want to come sit on a panel, answer some questions. If you're available, please come visit, because
I will definitely drop by, and it's in my backyard, so I'd love to.
Oh yeah, it's kind of a no-brainer. You must go. Awesome. Well, I'm really glad to hear you agree to do that. That'll be fantastic. So guys, he will be there. So if you haven't gotten your tickets, we're 2/3 sold out. So don't screw around and wait. We had a 50-person waiting list at the Tampa event that sold out. Okay, so is there someone in your life? I mean, we talked about mentors, and we talked about the importance of that. I guess you said it already. Your father, and yeah, okay. So he had a tremendous impact on you. Fantastic.
I've had multiple mentors. I mean,
right.
Other real estate professionals that have had incredible long careers have helped me so much. Some of them have helped us close deals financially, give us these bridge loans that other lenders wouldn't do because they didn't get it first, just because it's a good relationship. And we've invested in some of their deals now. And it's just been a good, just win-win situation, having good mentors and other business, not even in the business, but other business owners that have dealt with some of the same issues we have, as mentors. And I think just having a good, no one person could do everything, right? I mean, we're a company, and we're a corporate citizen, and we're trying to just build the best team around us to help us.
I love it. I love it. I can see it. I can feel it. That you're doing this from the right place. Let me ask you this: Are there any? Did you have to give anything up to get where you are right now? I mean, did you have to, give up any parts of your life to be as successful as you are? I mean.
No, I've always kept my ethics. I'm a firm believer in that.
Relationships. I mean, I talk, like I talk about.
We make it a family ordeal. So my wife is also in the real estate development business. She was a commercial broker, and she was making good money, but just got burnt out. She was doing tenant rep. She was representing office users, finding them office space. And she's very creative and very hardworking. So I sort of pushed her off to the ledge to start doing her own thing. She started with one home to flip it, and then started doing another, and then started developing single family homes, and then started building small apartment buildings. And now she's taking on even bigger projects. And it's cool to have someone else in the business and that I could talk to and that could relate to me. And then even our daughter, we have a 2-year-old daughter. We brought her to the construction sites with her little hard hat on. It's just part of our family. It's a family ordeal. It's I don't feel like I'm working. It's just like what I'm
cool.
loving
That's
to
cool.
do. And haven't been able to the only thing I've sacrificed now is my golf game's gone down the toilet.
All right.
But
So you had
it's
to
not
give
as
up,
important to me.
give up golf. Okay. All right.
It's not as important to me as family and work. So.
Oh, that's awesome. That's awesome. Yeah, I love the 2-year-old with a hard hat. So you're actually building some multifamily as well then?
Correct. So we have a 250 unit in Reseda, so in the LA area that we just broke ground on. We're following that up with a 170 unit in Tarzana. My wife's working on a 21 unit. She's in the framing part right now. We have a 9 unit in East Hollywood. So we're doing a lot of ground up development. We're like I said, opportunistic. So we started with just repositioning. Then we saw the opportunities to start doing some development. We started small and then started doing bigger projects. And then I didn't really talk about it. We started happy home communities. We're buying mobile home parks now because I see apartments, just the prices have gotten pretty astronomical. And a lot of people don't know, but Fannie and Freddie are lending on these mobile home parks.
Yeah, if they're good enough. Yeah, I mean they've got to have curbs, and it's something I know a lot about. Actually, I in another life I was doing that, and same here, same. I feel complete. I've had 8 virtual assistants working on a mailing list for mobile home parks in this whole country for a year. So nice. It's something that we're aggressively getting into as well. And of course, my good friend Kevin Bupp has the #1 podcast on mobile home parks in the country, and he's one of my best friends. And so my brother owns a bunch, and it's just something that I and that's fantastic. Now you have like 700 units, right?
Yeah, we just started that a year ago. We bought 6 parks, over 700 spaces, and it just fits in with the whole affordability crisis that's going on. Rents are climbing tremendously. Right. House prices are climbing tremendously. And then we're just worried there's so much new supply of apartments in certain markets, and we're starting to see the rents really grow, the growth slowing. Also, we're long-term holders, so these mobile home parks don't have the same CapEx needs because the homes are owned by the residents. Right. You just have to take care of the common areas, the pool, the clubhouse, the roads. So for long-term owners, and we're buying them at slightly higher cap rates than the apartments, so the cash flow is higher. And they're not really building too many new parks. I mean, you have some parks that are expanding in certain areas, but the cities, they don't drive.
They don't like. Nobody wants a mobile home park in their backyard. So no,
yeah.
it's pretty much. There's a huge barrier to entry. Now I agree completely with you. No, you guys, that's fantastic. And this whole ground up development as well. Like your wife's doing a 20 unit. We talked about it on the show a few weeks ago. That's an opportunity now. The rents have gotten to a place where. You go find some land, and for those of you that don't have a lot of money, you find some land that's free and clear, and involve the owner of that land in the deal, and you can probably put it together with little or no money out of pocket. They throw the land into the deal for the equity, and you're
still, even though we're bigger now, we're still working on something like that where someone contributes the land, and we do all the work and have some partnership. And the first development deal of size 9 units, my wife was scouring the residential MLS, and it was a church that we bought. It wasn't really meant to be on the residential MLS, and we sort of got it at a great price just because it was one of the members of the church was selling it, and I don't think they really knew the development value of it. And there's deals out there. You just have to really look hard and be creative and try how to get it. So.
No question. I could keep going with questions here, but we're running low on time. You've added a tremendous amount of value. I'd love to have you back on at some point to talk about negotiation, because I know you love to negotiate. So maybe we'll do that another time. But, I just want to thank you for being on the show, buddy. You really added a ton of value. Guys, you can reach him at geltinc.com, GELT-Inc.com. And I will look forward to meeting you in LA at my event. Awesome. And I'll make sure we connect to make that happen. So, all right. Well, thanks for being on the show, my friend.
Thanks for having me, Rod. Appreciate it.
Absolutely. Take care.
Take care.
Thank you for listening to the Lifetime Cash Flow Through Real Estate Investing podcast. If you've enjoyed the show, please take a minute to visit iTunes and leave your comments. For more resources or to connect with us further, please visit our website at rodkhleif.com. Tune in next week for our next show.